equity versus debt investing. So let's jump right into it here. Quick disclaimer, this is not a solicitation for funds, tax advice, or legal advice. We're going to talk about the difference between equity and debt investing and how investors might select what's the best fit based on their investment goals. I see more people who are jumping on. So as we do that, if you have any questions, please put them in the chat with the Q&A. I'm going to answer all questions at the end of the presentation here so we can move along swiftly. And if you can't hear me or see me or there's any technical difficulties, also please let me know in the chat there so we can make sure there's no issues here. So a little bit more about us here at People's Capital Group. We've been around since 2013, helping investors build and preserve their wealth through bespoke real estate investment opportunities here in northern New Jersey. We only focus on Class C, B, and sometimes A buildings and repositioning them into more desirable places to live, increasing the rent roll and the revenue on those buildings, creating more forms of income through amenities, improved management on the asset, and then exiting the asset over time through a refinance or a sale of the property. We also have a debt fund. The debt funds allows investors to invest as a lender, hold a promissory note, protect their investment through promissory note, and also earn a quarterly interest payment. So we'll talk about kind of the difference between those two investments, whether you're invested in an apartment building, getting cash flow, big lump sum payments upon the refinance and sale of the asset, and tax depreciation as well, or debt investing, where you're holding a promissory note. You know exactly what you're getting and when you're getting it, but there are less tax benefits and less higher target returns for those investments. So there's a trade-off for both. Seth Martinez, my business partner, and I have done about 300 transactions here in New Jersey, and we have an investor retention rate of about 83%. So that means over 8 out of 10 investors who invest with us continue to invest in additional opportunities after a liquidity event. We have about 100 investors, mostly accredited investors, sign out with individuals and family offices that invest with us here, mostly in the tri-state area, but throughout the country as well. All right, so here's our agenda today. We're going to focus on the difference between debt and equity investments. We're talking about what's a better fit for you as an investor based on your investment goals personally. The expectations investors should have, whether you're invested in a debt or an equity investment. What are your expectations from that operator and from that investment as well? And why we're actually seeing over the last couple of years, some investors prefer debt over equity investments, where I'd say 2-4 years before that, that was not the case. A lot of people were trying to get on the equity side. So why have the tides changed a little bit? And is that going to continue or maybe go back towards equity investments, right? We'll see. All right, so debt versus equity investing here. These are the meat and potatoes. So debt is more predictable, and that's why a lot of investors enjoy it. So when I say debt, that means you are a lender, okay? You can invest in debt in a lot of different ways. You could be a private lender, right? Sometimes when we buy a fix and flip property here at People's Capital Group, we'll call up one of our private lenders who's lent to us for years. He'll secure his money in a first lien position on the property. He'll get an interest payment as well. Actually, the interest accrues on that loan because that's how we structure our loans with this private investor. And then that investor will get an interest payment at the end of the loan, or you can also structure it to get monthly payments or quarterly payments, and you're securing your money on title of real estate. You're the lender, you're the bank. A lot of people like that position compared to equity, where you are in the project, right? You're the cash that is the down payment on the loan. You're the cash that is the closing costs or the renovation funds. You're a partner sometimes, or a passive partner in the investment. So that's the difference between debt and equity. There are debt funds, there are equity funds, right? So there's lots of different ways to invest in both debt and equity. The main differences here is debt tends to be more predictable. Whether you're investing in a debt fund that is going to be lending that money out, it's a little more predictable. You're making a loan out to a borrower, an operator. They're going to to an interest rate, they're going to agree to get foreclosed on, right? There's also an interest payment that's due. You better pay that interest payment, or again, you're going to be in default on the loan. So it's a little more predictable in what you're earning, where equity is less predictable. You don't have to pay equity cash flow, right? If you're having a down quarter, there's a recession or repairs were higher than you thought, or vacancies are higher than you predicted, well, you might not have a quarterly cash flow that quarter for your investors. So equity is a little more hit or miss, but can also produce higher returns, which we'll get into in a second here. Also in debt, returns tend to be realized soon. Okay. You're simply lending the money. You're getting an monthly schedule. So you're able to start earning a check or a ACH deposit as we do right away. Right? And generally within the first month, the first quarter of that investment. Now, every debt structure can be different. With our debt fund, the first year the interest accrues and it's paid out in a lump sum. And then the years thereafter, it's paid out on a quarterly basis. For our private investors that invest in our fix and flips directly as a hard money lender, we have that interest accrue and we pay that interest at the end of the investment period, whether it be 1 or 2 years. As a borrower, that's good. You rather push off those interest payments to the end of your flip, right? Your fix and flip, right? So that's, of course, how we structure borrowing as borrowers. But we've been doing this 13 years and done hundreds of transactions. So a lot of the people who are lending to us are quite comfortable with us and give us very attractive terms as borrowers. So if you're starting out, that might not be an option to you. Or if you're working with a regular hard money lender, they're going to ask you to make a quarterly interest payment. And as a lender, that might be very attractive to you to get a quarterly check in the mail or quarterly ACH deposit. A lot of investors like that, especially if you're kind of trying to live on the returns and the investment, which we never suggest. But of course, often that's how investors, especially at an older age, may be investing. That might be their goals. And of course, secured. So debt is often secured. The principal is often secured either on real estate title or through a promissory note. In the case of our debt fund, we secure that investment through a promissory note. That's a black and white written agreement. It says exactly how much you're going to earn on your investment and exactly when that investment will be repaid in full. No questions asked. It doesn't matter if interest rates go up or interest rates go down, markets go up or markets go down. If the money we're lending out to our projects out of that debt fund, whether they work out or not, those do not affect the returns or the experience investor. If you're secured on title, so debt is often a secured investment that offers the lender or the investor more protection. Equity. All right, so equity generally offers higher returns. There is a little more risk to it, but with more risk comes more reward. So it's trade-off, right? Depends on your appetite for risk, whether you choose debt or equity or really a combination of both, which many investors do. Equity often targets returns between 15 to 20% internal rate of return. An internal rate of return takes into account the time your money is also at work, in addition to your cash and cash return. It's arguably a more it's arguably a more income. I don't know exactly the way to describe it, but it's a better way of identifying your return on investment, right? Because if you invest money in an opportunity, say a development opportunity, and you don't see a return on investment until the property is built and leased up and then refinanced or sold, it could be 4 years till you get your return on investment, right? However, maybe your return on investment is a 2x. So you put in $100,000, after 4 years, you get back $200,000 when they sell the asset, right? Okay, that's not a bad investment. We have to recognize on an annualized cash and cash return basis, that would be a 25% annualized cash and cash return, because you're basically making a 2x return on your investment over 4 years or 100% return over 4 years. 100% divided by 4 is going to give you a 25% annualized cash and cash return. But that's not really telling the whole picture, because you waited 4 years for that payout. So your IRR would actually be much lower than 25%. So an IRR takes into account how long your money is at work, and the longer your money is out at work, the lower your IRR is. The faster I can get your money. IRR and cash returns are very different metrics. You have to understand the difference as a passive investor. If you have questions about this, by the way, I'll put a link in the chat where you can schedule a call with me, Aaron Fragnito. We could talk about difference between IRR and cash return until the cows come home. So it's important to know that difference, though. So the main focus here is that on equity investments, we're generally targeting between a 15 to 20% IRR. We just bought an apartment building. We're targeting a 19% IRR in that deal. That's a 1.9x equity multiple. That means over 5 years on that investment, if you invest $100,000, you'd expect to walk away with about $190,000 over that 5-year period. Where on a debt investment, on our debt fund, say you invested $30,000 for 3 years, you'd earn a 9% interest rate. So that's $2,700 a year times three, right? So that's about $8,000 or so, right? So on 30,000 or less, you invested $100,000, you locked in a 10% with $130,000 over that same over a 3-year period, or $150,000 over a 5-year period. Although in our debt fund, you're limited to a 3-year period. So the bottom line is, in the equity scenario I explained, $100,000 turns into $190,000 over 5 years if the project goes according to plan. In a debt scenario, when I explained, $100,000 would return $150,000 over a 5-year period. And so obviously the return on investment in an equity investment is higher by quite a bit in the debt investment. And that 10 to 17% IRR for Class C to B buildings, we're generally targeting an 18 to 19% IRR. Where debt investments tend to pay a 6 to 12% annual interest rate. Okay, obviously a big difference there. So you're, in exchange for more predictability in your investment and more security in your investment, you are sacrificing a large amount of return on investment. So that's why a lot of investors diversify across both options. Equity returns are also primarily realized through a liquidity event, right? The property has to be sold or refinanced for the majority of an equity investment to be returned and the majority of the profit to be realized. Generally, 80% of an equity investment is realized through a refinance or sale of a property. The other 20% of the return investment is generally realized through cash flow. Okay, depending on the investment. Okay, if you're in the Midwest, you're going to have higher cash flow, but maybe less equity growth. Here in the Northeast, you're going to have higher equity growth and less cash flow, right? But the bottom line is equity returns are a little more deferred, right? You're going to realize those returns later in the investment period than you are with debt, where debt tends to pay out on a consistent quarterly or monthly basis. But there's no big equity kicker on the back end with debt. Okay. When you're in an equity position, if the markets do really well, you could do really well. You have the potential to do overperform targets. But if markets go into recession or you invest in the wrong operator, the investment can perform below target as well. Equity also has another benefit over debt in that it offers tax benefits. Most of the time when you're investing as an equity investor, either a passive or active investor, as an equity partner, you're able to enjoy the benefits of the tax depreciation of real estate investment. In fact, when we buy an apartment building, often what we do is we do something called a cost segregation study. And we front load that tax depreciation and we distribute up to a 25 to 30% tax write-off for investors in the first year of investing in that property. So for example, this apartment building we just bought in Passaic, New Jersey, we did investors enjoyed a $25,000 tax write-off in the same calendar year they invested. So for 2024. So you get a big tax write-off if your operator is investing in commercial real estate. And you also get tax depreciation along the way. Now, tax depreciation and the tax write-offs I'm speaking about are paper write-offs. It doesn't mean you lose $25,000 of your $100,000 investment. It just means you were able to write off 25% of your investment in that scenario. So it's a paper tax write-off, which is a beautiful thing because you can use that to then write off other gains on other passive investments. Or if you're an active investor, you can use your tax write-off to write off other gains on other active investments. If you have questions about tax depreciations and cost segregation studies, that's a great reason also to schedule a call with me. We can talk about the tax benefits of investing in real estate, compare them to debt. Now, with debt, you're a lender. You're earning an interest rate. At the end of the year, you get a 1099 tax form. Okay, now there's different scenarios. You can invest as an equity investor in a debt fund, but I'm just speaking in general terms here. As a debt investor, when you're a lender, you hold a promissory note or you're in a mortgage position on a property, you are going to receive taxable interest income, and you'll receive a 1099 form at the appreciation. Now, if you sell the property 5 years down the road, as we tend to do, that could be a taxable liquidity event. So keep that in mind. If you refinance the asset, that's a non-taxable liquidity event. So you're able to harvest that equity growth, put cash in your pocket, and not pay taxes on it as an equity investment when there's a refinance that takes place. When a sale takes place, it is a taxable liquidity event. So the bottom line is the tax benefits of investing in equity tend to be greater than in debt. So if not paying taxes is one of your main goals and earning a higher return investment is one of your main goals, then you might like equity more than debt. If being secured and having a predictable investment and front loading your returns rather than getting paid more on the back end, then you probably like debt or equity. So what's a better fit for you? What are your investment goals, right? Again, as I said, lower risk. If you have a stomach for less risk, then you're probably going to lean more towards debt investments. That's often lower risk because it's not based on a project's performance or market dynamics, right? It's when you invest in our debt fund, you lock in that interest rate, $100,000 at 10% interest. You know exactly what you're getting when you're getting. You're earning $10,000 a year in interest, $2,500 a quarter. At the end of that 3-year investment, you get back your $100,000 principal, and that's it. Simple, predictable, secured. Some investors like that, right? But on equity, you can earn double that return. Heck, we've done deals where investors earn 2 times our targets, right? Because when markets were good, we overperformed, right? But you can also have scenarios where operators underperform in equity as well. So it's not as predictable. It's faster returns, and it tends to be with debt, right? So if you want to earn income sooner, you're not worried about the entire amount of income, but you just want to earn it sooner, debt is probably a better fit for you. Debt often pays sooner and at a higher rate in the beginning, but equity investments can offer high cash flow as well. So again, in the Northeast here, we tend to focus more on equity, right? Equity growth. Our 80% of returns on our investments are real, sometimes even more than that. 90% of our returns to investors are realized through the refinance, generally years 3 to 4, and the sale of the asset, generally years 5. So what you're seeing is cash flow starts and then grows over time. A lot of times cash flow will be 1 or 2% the first year we buy a property as we reposition the asset, renovate units as tenants move out, implement amenities in the property, improve the management of the asset, increase the revenue of the building. These things take time. And as you have a lot of turnover in the first 3 years of ownership, turnover limits your cash flow. So on an equity investment, especially on a heavy value add, you're going to have low cash flow, but that's going to grow over time. And then hopefully, if the operator is good, get you to a big liquidity event, like a refinance and then eventually a sale. But you have to be patient in equity, where debt can pay out sooner, right? You invest in the PCG debt fund, at least in our debt fund, the first year it accrues, but at the end of that year, you get $100,000 at 10%, you get a $10,000 payment, right? We're an apartment building. If you're investing in an apartment building with us, the first year you might get a 2% cash flow, right? So on a $100,000 investment, you'd expect about $2,000. By year 2, you'd expect around 4% or $4,000. Year 3, you'd expect maybe 6 to 8% or $6,000 to $8,000. And then beginning year 4, we plan to do a refinance. This 4 unit we recently purchased, where you'd expect about 80% of your investment back or $80,000, right? So it takes more patience with equity, but you can earn much higher returns. And upon the sale, we expect to earn about another $90,000 or so in profit on a $100,000 investment. Where with debt, you're simply investing, you're earning a quarterly interest payment, and then at the end of that loan period, you get back your principal. There's no big equity kicker. There's no refinance payout. There's no sale payout. It's straight and simple, right to the point. $100,000, 10% interest, $2,500 a quarter. At the end of the 3 years, you get back your $100,000, and that's it, right? So you're limited to what you can earn in debt, but you know exactly what you're going to get. And finally, debt's secured. Often debt is backed by a hard asset in a lien position or at the very least a promissory note. So again, the promissory note will outline the interest rate, the term of the loan, and what the funds are generally used for, the guarantors, and so on. If you're in a first lien position on a property, even better, take back the asset. Right now, that's a big headache. And so as a debt investor, you got to be aware of that. You don't want to be, unless that's your goal, but generally you're investing in assets with good operators and your intention is to not foreclose on them, right? And it's not really anyone's goal, although that is some, like a vulture debt lender might have that goal, but that's generally not a lender's goal. It's to not end up in a foreclosure, to not end up in default, right? Same with the borrower, of course, that's not your goal, right? But you have recourse with debt. It's often backed by a hard asset. It's secured in a lien position, or it's secured by a promissory note. So that is a safer position with debt. So again, debt tends to be less risk, but equity tends to be higher reward. So on that note, equity targets higher returns. You can produce a higher than targeted return, right? In a good market in the last few years, not so much these days, but when times were booming in 2022 or so, we were achieving far greater than targeted returns to investors. We were refinancing 2 years ahead of schedule, getting back 50% of investors' capital 2 years into investments, right? Well, we targeted that over a 4-year period, but we were achieving it in 2 years because the market was good. The market was hot. We're able to boost prices more and refinance them at higher targeted values. And so good operators in a good market, they're going to overperform your equity targets. It's one of the beautiful things about equity. However, even a good operator in a down market is going to struggle to overperform. Hopefully they're a smart operator and they were conservative on their projections and estimations. And if so, in a down market, they're going to just be hitting target. Which again, target returns on an equity can be about 2x what you'll see on debt investments often. And finally, for equity, it tends to be a longer investment period. At least for our debt fund, you can invest for 1 year, 2 years, or 3 years. The most is 3 years. The minimum is 1 year. For equity investments, it's generally a 5-year investment. Some equity investments can be 3 years, some can be up to 7 years, or even 10 years. But equity investments, you tend to be locking in your capital. Again, these are illiquid investments, unless you're in some type of secondary market or whatnot, but we'll focus on just most real estate syndications here. Illiquid investments that you're not going to be able to exit for generally 5 years. And exit's not as predictable as debt, right? When we borrow money in the debt fund, when a lender debt fund, we borrow that money for a finite amount of time, either 1, 2, or 3 years. At the end of that loan term, the money is owed back. In an equity investment, we have a plan, right? We plan to sell the property over 5 years. We plan to refinance the building beginning of year 4, but it's not as set in stone. In an equity investment, the operators have some bandwidth. Maybe the market's really hot in 3 years. We're going to sell the building in 3 years. Great. Maybe the market's in a recession in 5 years when we go to sell, and it's a down market. It's a terrible time to sell. We might still sell, but we might not hit targets. We might say, hey, let's wait a year or two. Let's see if we can sell in better markets. So the operators have some freedom to choose what's best for the investors. Where a debt investment, you do not have that freedom. The borrower's locked into terms based on a promissory note that you have to follow or you're in default. Okay, expectations as a private investor. Let's break into this here. All right, so consistent communication. I like to over communicate with my investors. When you invest in a deal with People's Capital Group, you're going to know exactly what's going on with your building, with your investment. And even if the update is we're facing challenges, we're firing a contractor, we're struggling with rent collections, we are challenged in this way or that way. Transparent with the good news as well, right? The good and the bad news. So I send out monthly updates. Some investors, some operators do quarterly updates. I think monthly updates are better because um, you can follow your investment more closely that way, and if you want quarterly updates, you can open those emails every quarter, right? So that's it. So we send out monthly updates with rent collection reports, often pictures, videos, detailed accounting of exactly what's going on with our investors' building. Quarterly financials. Every quarter, we send out a balance sheet, a profit and loss statement, and a distribution statement that shows exactly what is owed on the balance sheet, the profit and loss, the money coming in, the money going out, and distributions. If any distributions are made, it'll be disclosed on that distribution sheet, distributions to investors. So clear, concise financials every quarter, along with a quarterly distribution, which is an ACH deposit right to our investors' account if there's available positive cash flow. If it's the debt fund, well, that quarterly distribution is going out no matter what because it's a loan and we owe that interest payment every quarter as agreed. If it's a equity investment and we're having a down quarter, there might not be a distribution that quarter, or there might be a larger than expected distribution that quarter, right? Equity investments, uh, can be higher or lower than targeted. You also want clear, concise offering documents and well-organized offering documents so you know exactly what you're investing in, what the risks are, and what your requirements are as an investor. And a fast response to inquiries. Even if an investor texts me or calls me or emails me on a Saturday night and I'm spending time with my beautiful 3-year-old son, I still try to respond quickly, even if the answer is, hey, I need to look into this. I'll get back to you on Monday. At least, I'm there. At least, that I'm fielding your answer. I'll need to do more research or I'll need to look back at the numbers and get back to you when I'm in the office on Monday. But I always make a point of responding to investors within an hour or two, basically as soon as I see the message, even if the answer is, I'll get back to you shortly, right? Because I know that whenever I'm investing in a deal, I want to at least know that you saw my message and you're working on it, right? I don't expect you to jump out of the movie theater you're sung with on a Saturday afternoon or something, go answer my question, but I do like the fact that, quick communication, concise communication, professional communication is what you should expect from your operator. Solutions, not problems. So when a problem arises in the project, operators should come to you with a solution and to the problem that they're disclosing, not just the problem, right? Our contractor didn't show up, and now we're behind on the renovation of this unit, but we have interviewed 3 other contractors. We are probably going to be going forward with this contractor. We're just waiting for their insurance and license. We need a copy of that. We also have additional contractors lined up that we can interview and get a quote from if these contractors don't give us the right quote. Or we have a backup contractor already doing the work. Our materials didn't show up. We have another source of materials that we're in touch with. They expect to deliver the materials next week. We didn't win a court case with a tenant where we're hiring a new attorney. We're appealing the court case, or we're going to now take this route, right? Whatever the scenario is, you always want to have a solution to the problem. We didn't meet our cash flow numbers this quarter. Here's what we're doing to make sure in the future we achieve our cash flow targets, right? Solutions, not problems. A cash call or default. So as an investor, you need to understand what happens if the operator runs out of money. What happens if they're wrong about their repair estimates? What happens if they operate the property poorly and they don't have enough money to pay the mortgage that month? There could be a cash call. in an equity investment. That means the operator can go to that back to the investors and say, hey, we need every investor, to write a check, right? And based on how much ownership you have in the property, the larger that check will be. We need $100,000 cash injection. So if you own 5% of the property, you need to write a check for $5,000, right? Understands $5,000, it can be diluted from your equity. Your equity could be diluted. Now, we've never done a cash call. We never plan on doing a cash call. Operators do not want to do cash calls. Investors do not like cash calls. It could be the kiss of death for an operator. So, we've made sure to never do cash calls here at People's Capital Group. On the debt side, you have default, right? If you can't pay your mortgage, you default on that note, you default on that loan. That's a risk as a lender. There is risk to debt investing. You don't eliminate all the risk, but you a little more than equity. So a debt investment, when a borrower defaults on a loan, generally the lender has recourse. They can start foreclosure proceedings on that borrower and try to maybe work out a deed in lieu where the borrower will just sign the deed back over to the bank or the lender, say, here's the property, just take it. Obviously, the worst case scenarios. On a promissory note, you can sue the borrower and have a very, very strong case to take that borrower to court and get paid in court. If you're in a second or third lien position, you have to foreclose over the first lien. It can get a little messy, and what happens in the event of default? What does the interest rate go to? How long does the borrower have to cure that default? And what are your ramification options as a lender? And a good operator should be able to explain that to you, and maybe a good attorney too. So next here, why recently investors have preferred debt investments. All right, so from 2018 to 2022, we saw a huge demand for equity investments. You could send out an email to our list of 5,000 investors and raise money. People wanted to invest in equity deals. It's very popular. A lot of real estate syndicators raised a lot of money. Then in 2022, interest rates started to increase, markets started to slow down, and recession fears increased. People became more bearish on the market. The government had printed a lot of money for COVID relief. And all those dollars being circulated into the US economy created inflation, hyperinflation. And we were very worried about a recession. If you recall back to 22 and 23, right? Inflation was like 8%, 9%. It was crazy. And it was a scary time. And investor sentiment was bearish. So in a bearish market, when investors are nervous about market strength and health, they tend to move into less risky investments, more secure investments, which would mean debt. So around 2022, investors started to move towards debt investments and prefer those over equity. So investors are bearish on the market, and that bearish mentality kind of continues to today. I think a lot of investors are starting to be a little more bullish, but there is a lot of volatility in the market and a lot of unpredictability with tariffs and the new administration and so on. And I think it's a little short-term pain before we have long-term gain. So there is a renewed fear for recession during this time. And when there's fear, investors move to debt investments generally. So they're more bearish on the stock market these days. Some investors predict commercial real estate prices and the stock market will continue to drop and prefer non-correlated investments. A lot of investors like the fact you invest in the PCG debt fund, lock in a nice, strong interest rate, get that quarterly interest payment no matter what, get your principal back at the end of the investment no matter what, whether markets go up or markets go down, interest rates go up or interest rates go down, you get that return on investment. Predictability, right? In a more volatile market, like we see recently, the stock market's fluctuated 12 points in the last like 2 weeks, up and down, up and down. Investors tend to prefer more predictable investments over higher returns. That would lead to a debt investment, right? They're very predictable, black and white, cut and dry, not as exciting as equity investments, but predictability wins in a more volatile market for many investors. And finally, recourse. In the event of default, investors want recourse strategy, which debt usually offers where equity does not. Right? If you invest in the wrong equity opportunity and the operator is not doing their job right, and they end up having to give the property back to the bank, that equity investment can be wiped out entirely, right? Or if you invest in a stock in a company, that company fails and closes its doors, well, that investment can be lost entirely. Generally, with debt, yes, you can have, there can be storms, there can be defaults, but if a if a borrower doesn't pay their mortgage payment, you have recourse. You can file foreclosure on the property. You can work out a deed in lieu of foreclosure with the owner, which is where you give the deed back to the bank in exchange for, not defaulting on the loan, in exchange having to go through the foreclosure process. So bottom line is also with the promissory note, right? If the borrower doesn't pay, you can file a lawsuit and have a very clear path to getting that note paid. All right. So there's clear recourse with debt positions, debt investing. And that's why a lot of investors have gone towards debt recently, as we've seen more recession fears. All right, so here's a quick slide on what does People's Capital Group offer, and then we'll wrap up for questions here. Again, if you have any questions, please put them in the chat. I encourage questions here as we go. So we have a debt fund and an equity fund. Our debt fund, our minimum investment is $30,000. We offer 1 to 3 year loan options. You're the lender, we're the borrower. We pool the capital together in a fund, PCG Fund 2, and we lend that money out to own fix and flips and our own land purchases. We're basically our own hard money lender. There are rules within that loan as far as how much we can lend to our own projects and so on. But the money is secured through the fund in a first or second lien position or used as deposits on real estate purchases. The investors in that fund, in the debt fund, hold a promissory note. That promissory note shows exactly what they're earning, okay, the interest rate and the term of the loan. The longer you invest or the more you invest, the higher that interest rate goes. For example, the minimum investment of $30,000 for the minimum period of time, 1 year, would earn the minimum interest rate, which is 8%. $30,000 invested over 2 years would increase the interest rate to 8.5%, which you lock in for that entire investment period. $30,000 for 3 years would boost that interest rate to 9%. The other way to increase the interest rate is by investing a larger amount. So if you invested $100,000, which is the next bracket beyond 30, for 1 year, 100,000 would be 8.5%. 100,000 at 2 years is 9%. 100,000 at 3 years is 9.5%. So obviously, the more you invest or the longer you invest increases that interest rate. The maximum investment is $1 million. The minimum is $30,000. The brackets are 30,000, 100,000, 250, 500, and $1 million. The first year, the interest accrues, then it's paid out in one lump sum at the end of that year. And then the interest is paid on a quarterly basis, okay, based on that annual interest rate. We accept non-accredited investors into our debt funds. You don't have to be an accredited investor. An accredited investor is someone with a net worth of $1 million, not including their primary residence, or an income of $200,000 individually, or $300,000 including their spouse. That's an accredited investor. You do have to be an accredited investor to invest in our equity fund. Our equity fund has a minimum investment of $50,000. It's generally a 3 to 5 year investment period. Each fund invests in one particular property. So we have one particular property you can invest in right now in our equity fund. This property is a 42 unit in Passaic, New Jersey. It's targeting a 19% target annual IRR, internal rate of return, for our investors. It's a 1.9x equity multiple. That means on a $100,000 investment, you'd expect to walk away with about $190,000 over that 5-year period. That's a combination of cash flow, which is paid out on a quarterly basis, refinance, which is targeted for month 37, where investors should expect 80% of their initial investment back, and then sale, which is targeted for month 60, or the end of 5 years. Quarterly cash flow distributions are based on net cash flow. So if it's a down quarter, we're aggressively repositioning the asset, there's a high amount of vacancies, and we don't have net positive cash flow that quarter, there's not going to be a distribution. Where a debt investment, that quarterly distribution is non-negotiable. Right? So that's the difference between debt and equity there. Our equity fund is for accredited investors only. Our debt fund is open to non-accredited, sophisticated investors. If you're not sure about where you fit in that category, we can schedule a call and discuss how you would qualify for those opportunities. Here's our 5-year plan here at PCG. We recently closed on that 42 unit in Passaic, New Jersey, building our AUM to $40 million. AUM stands for assets under management. And here, 2025, we plan to refinance or sell 1 to 2 assets, creating a liquidity event for many investors. We're also working to raise $10 to $20 million and acquiring $20 to $40 million in assets. We plan to lock up 2 different properties right now. We're very close on 2 LOIs, and we're working with institutional level investors and family offices to raise about $15 million for those acquisitions. In 2026, we plan to raise another $25 million and acquire roughly $50 million in assets and sell or refinance 1 or 2 older assets as well to create additional liquidity events for our current investor base. 2027, we plan to raise another $50 million and acquire about $100 million in assets and sell or refinance an additional 1 to 2 assets to create more liquidity events for our investors. 2028 to 29, we'll begin harvesting those assets that we're buying right now and ideally creating large liquidity events for our investors in those buildings. Here's our team. That's me, Aaron Fragnito, on the left. There's Seth Martinez. I primarily work with our clients and our investors. I do a monthly educational webinar here. I do a podcast every 2 weeks now. We have about 170 podcast episodes called the Passive Cash Flow Podcast. You can check that out on Spotify and Apple iTunes, all the major platforms, YouTube as well. We have hundreds of videos on YouTube, all educational videos, lots of interesting guests as well. And all of it's free. We don't sell education. We just help people build and preserve their wealth through real estate. I wrote and taught a course called Real Estate Entrepreneurship at Rowan University. Just for 1 semester. It was a lot more work than I thought, but it was a great experience. Seth handles our operations. Seth has over 20 years of entrepreneurship experience. We've done about 300 deals together, Seth and I, here in Northern New Jersey. He's managing our management company. He's operating our debt fund. He's reviewing opportunities for the debt fund and making sure the trains run on time, as we say here at PCG. Lena's our property manager. She is hardworking. She's incredible. She manages our leasing staff, our boots on the ground. She is making sure our buildings get repositioned aggressively and our projects are on target and on budget. She's managing our contractors as well. She ensures our tenants have a high quality experience. A happy tenant equals a happy investor, as we say. And there's Dana Sargenti, our amazing bookkeeper and record keeper. She makes sure our ACH deposits go out on time. So you better be nice to Dana. She makes sure our quarterly financials are well prepared. Our annual K-1 tax returns are done properly and accurately. Our invoices get paid on time. And she makes sure that our financials are accurate and our bookkeeping is accurate. We work with numerous independent contractors. We have 4 to 8 independent contractor teams moving at any time throughout our properties. These are general contractors that have subcontractors under them. So we're managing 4 to 8 general contractors at any given time. Leasing agents that go out and lease our vacant units, our renovated vacant units to quality tenants. The best way to avoid a high eviction rate and a high vacancy rate is to lease to the right tenant from the start. And that is accomplished by working with the right leasing agents and having strict criteria for who you accept in your building as a tenant. Content specialists. We have over 170 podcast episodes, hundreds of educational videos, dozens of webinars and masterclasses, numerous ebooks. You can all check that out at peoplescapitalgroup.com. It's all free. IT professionals, we have an investor portal you can log on to. And on that portal, you can see how your investments are doing, similar to Ameritrade Financial or something like that, where you invest on, see how your stock portfolio is doing, except in our case, it's real estate. You log onto your portal, our portal here, People's Capital Group, review the monthly updates, the quarterly financials, the annual tax forms. That's all also emailed to you, but you can get access at any time. And then also see upcoming opportunities and past performance on our investor portal. We have numerous virtual assistants. We run a pretty lean, mean shop here. Lena has a number of virtual assistants. So do I as well. We have tax specialists and 1031 intermediaries. So if you have a property you're looking to sell, we do one-off 1031s. A minimum investment's $1 million. But if you have a property you're thinking about selling or a property on the market and you expect to earn over $1 million from that sale, let's get in touch. We can help you 1031 that money, do a 1031 exchange, defer all taxes, move into a passive investment here at People's Capital Group using the 1031 exchange strategy. Again, the minimum of that is $1 million. Attorneys, we work with all different types of attorneys. You want to make sure you're working with the right attorney for the right job, whether it's an eviction, landlord-tenant court, an acquisition of commercial real estate or residential real estate. You got to use different attorneys. Don't use a residential attorney for a commercial acquisition and vice versa. Affordable housing, SEC attorneys for the creations of our investment documents, and the list goes on. So we work with all different types of specialized attorneys, corporate attorneys, right, and so on. Property due diligence and acquisition experts. So we have a team of underwriters, professional institutional grade underwriters that underwrite our deals. If you've ever seen our Excel models that we use to underwrite these opportunities, they're extremely in depth. If you want a copy of those models and you're a qualified investor, we can send that to you. Bankers, realtors, broker-dealers, real estate specialists, lenders, realtors, wholesalers, right? So all types of real estate professionals, due diligence experts to make sure acquisitions and operations are completed flawlessly and professionally. So finally, thank you to our investors. We are only as successful as our investors. Our success is your success. Since 2013, many people have been investing with us for over 8 years. PCG would not be succeeding without the support of our loyal investor base, where over 83% of our investors reinvest after a liquidity event. So if you want to learn more about our debt fund or equity fund, I'm going to put a link here in the chat that allows you to schedule a call with me, Aaron Fragnito. And